From the outside, investing can look daunting. Between personal finance blogs, news sites, and social media, you're constantly overwhelmed with opinions and information that shape the way you use your money. Now, we all know that through investing, your money can make more money for you, but a lot of people are held back since they find it hard to decipher what's true and what's not. So here are 7 myths about investing that could be holding you back, and the truth that might help you gain a clearer understanding and encourage you to get started on your investing journey. Investing is reserved for the rich. One of the most widespread myths about investing is that it is exclusively for the rich. The reality is, anyone can invest and build their wealth over time. You don't need a huge sum of money to get started. Now, having more can be advantageous because larger investments can potentially result in higher returns, but it is by no means the standard. There are many different investment options available, and some of them are quite affordable. You can invest in low-cost index funds that track a specific market index, such as the S&P 500. Index funds are a great way to get started investing because they're diversified and have low fees and a lower risk profile. So, no matter how much money you have, you can get started investing. The key is to start small and gradually increase your investment over time. By investing early and for the long term, you can grow your wealth and reach your financial goals. You should pay off debts before investing. The second myth about investing that keeps people away is the idea that you should be completely debt-free before investing. This isn't always the best advice. There are a few reasons why you might not want to wait until you're debt-free to start. First, the longer you wait, the less time your money has to grow. The less time it has to grow, the less it can compound. Second, investing could potentially help you pay off debt faster. And third, investing can help you reach your financial goals quicker, making you less reliant on debt in the first place. Of course, there are also some risks associated with investing while you're in debt. If you invest money that you actually need for paying off your debt, you could end up in a worse financial situation. Or you could find your debt growing quicker than your actual investment, and when the market takes a downturn, you can lose even more money on your investments. So what's the best approach? It depends on your individual circumstances. If you have a lot of high interest debt, it makes sense to focus on paying that off first. But if you have some debt with lower interest rates and a solid emergency fund, you might be able to start investing right now. Otherwise, if you take 10 years to pay off your student loan debt, you will have missed out on 10 years of compounding growth, making it much more difficult to attain your financial goals. Just remember, if your debt interest rate is higher than your potential investment returns, it's smarter to pay off those debts first. Investing is a game of chance. Investing and gambling are two concepts that are sometimes used synonymously, especially with the shiny allure of day traders and the get-rich-quick ideas some crypto enthusiasts sell. We don't have anything against either of those things, but neither of them is investing. For one, they sell a get-rich-quick idea that doesn't represent the core of what it means to invest. Investing is not gambling. Gambling is a game of chance determined by luck. Investing is a long-term strategy for building wealth determined by your investment choices and the performance of the market. While investing in the stock market involves some risks, it is not a game of luck. Investors can make informed decisions based on their study and analysis of the market. They can estimate company profits that will be left for the shareholders, allowing them to maximize their wealth. Investing creates value for investors, increasing the overall wealth of an economy, while gambling only makes the casino richer and richer. You're too young to invest. There's no right age to invest. You're never too young to start investing. Of course, the earlier you start, the more time your money has to grow. But investing is based on your financial needs and goals, your risk tolerance, and the time horizon of your investments. Even if you can only invest a small amount each month, it will add up over time through the power of compounding interest. Compounding interest is one of the most important concepts in investing. Your money has the potential to grow exponentially over time, and the earlier you start investing, the more time you have to benefit from it. Long-term investments tend to be less volatile and may help you build more wealth and achieve financial freedom. When it comes to building wealth, time is your greatest advantage, and you get more of that advantage when you start young. You're too old to invest. It's true that the earlier you start investing, the more time your money has to grow. It's also true that investing at any age can help you reach your financial goals quicker. But if you're starting to invest later in life, you'll need to take a more conservative approach. While a younger person can take on more risky stocks, someone nearing retirement should do the opposite. The reason is, if things go wrong, as they sometimes do in investing, you don't want to lose too much. The younger investor has more time to bounce back while those nearer to retirement do not. It's a matter of making sure your investment strategy matches your situation and financial objectives. A 65-year-old new retiree obviously requires a different plan than a 30-year-old who is saving for retirement. Some people assume that investing later in life is too dangerous, yet if you leave everything in cash or a savings account, your money will not keep up with the rising cost of living due to inflation. The point is, it's never too late to invest. You just have to ensure you keep your financial goals in mind and cater to your specific needs. Investing is complicated. You have to be an expert. This myth implies that investing is only for those with advanced degrees in finance, a thorough grasp of economic theories, or a network of insider connections. The fear of making costly mistakes or losing hard-earned money makes this myth believable and often prevents people from taking their first steps toward financial growth. If you think about it, investing can seem like an intimidating task, especially if you don't have a lot of money or experience. But like we've mentioned earlier, you don't need a lot of money, nor do you need to be an expert to get started. Once you have a basic understanding of investing, you can start by investing in simple, low-cost index funds. You can then use this time to learn more, even while your money is allowed time to grow and compound. Investing can be as simple or as complex as you want it. By educating yourself, seeking guidance when needed, and adopting a long-term perspective, you can start building wealth and working toward your financial goals, even if you're not a money expert. There's an ideal time to invest. We're often told that in order to profit from the markets, you must buy when things are cheap and sell them at a profit. If you only follow this way of thinking, you may spend a lot of time and effort trying to determine when a market price has peaked or bottomed out in order to determine when to buy and when to sell. And while you're doing all of this, your money is sitting on the sidelines. This is a terrible way of approaching investing. Your goal as an investor should be to invest for as long as you can within your budget. The market will always reign, and timing it just doesn't work. There are many reasons for this. There will always be some downturns, but the key is to maintain your investments through the slump to ride out the negative curve. This is one of the main influences on the growth of your investment: time spent in the markets rather than timing the market. So, adopt a long-term perspective, diversify your portfolio, and stay invested through market fluctuations. This strategy, known as time in the market, has historically been a more reliable path to building wealth. Although not everything we read or hear about personal finance is accurate, there is one recurring truth: investing our money can help us achieve true riches. Now that you're aware of the truth behind some of these investing myths, hopefully it can help you make the necessary adjustments to how and why you invest. Investing is a powerful tool to have in your corner as you pursue financial freedom. So don't let these myths stop you from getting started. Don't forget to subscribe to the channel for more helpful videos on investing in personal finance. Give this video a thumbs up if you got any value. Thanks so much for watching. We'll see you in the next one.